Should Warren Buffett invest in Tesla? Should Warren Buffett have invested in Apple sooner than the first quarter of 2016? Look, I'm not here to disvalue investors. My purpose is to educate you so you can become a better investor. So if value investing doesn't work, then what is the best way to determine if a company is one where you want to become an owner of the business? Well, look, that last sentence is key to becoming a better investor. And in fact, the last 6 words tell the story. Become an owner of the business. Yes, you are investing in the business, not the current stock price or valuation. The best investment advice I was ever given was over 20 years ago by my father-in-law, Edwin Polikoff, who was a top producer at Merrill Lynch and just turned 100 years old this past March. He said, and I quote, "Find a company you believe in where the prospects of revenue and earnings growth are bright. Invest in the business and don't sell it until you don't believe the business story anymore." Notice he didn't say to sell it if it became overvalued or it went up a lot. He said to sell it if you lost your belief in the future prospects of the business. I was amazed at the returns of the businesses he journaled into my kids' UGMA accounts to help pay for their college educations. Companies with unrealized returns of 300%, 400%, 600%, and even higher. Maybe so many investors focus on valuations because it's a lot of work to evaluate the prospects of any given business. You must become at least somewhat of a subject matter expert in the business, and you have to analyze the markets, competitors, and the prospects of the business. It's a lot of work. No, let me rephrase that. It's a ton of work. Look at this. First of all, you need to start out by reading this book by Graham and Dodd. You see how thick it is? Called Security Analysis. That's just the beginning. And there's a lot of work after that. Luckily, these days, there are many good analysts who are doing much of that work for you. And you can gain insight from them on YouTube. But be very careful. There are very few good analysts out there. In fact, most of them are not worth your time. Kathy Wood and her team at ARK Invest do a great job of looking at high-growth companies, their markets, and their prospects. And the best part is the research is free. You can see her website here, ARK Invest, and there's lots of information here on different high-growth companies. And again, it's all free. You can listen to podcasts, YouTube videos, download research. It's a great resource. You can also go to websites like tipranks.com to find analysts who you might trust and look at their research. But ultimately, you've got to think for yourself and definitely stay away from opinions focused on the value of a company. In my opinion, the concept of buying a company at a good value allows investors to skip or gloss over all that analysis and just try to buy companies when they're cheap. Look, finance types like to lean on their income statements, balance sheets, and cash flow numbers because it's what they know. And judging if a company is one you should purchase by the current stock price over its discounted value or some other calculated value ignores the rest of the business case and future business opportunity. Many years ago, I heard a story about the finance people at Ford who went to the board meeting and suggested they close a plant because it would save the company money. So the board thought about it and agreed and closed the plant. At a later board meeting, the same finance people once again came to the board and suggested they close another production plant to save money for the firm. But this time, one of the board members suggested they close all of the plants and therefore would save even more money. After everyone stopped laughing, the board decided not to close any more production plants. I think you get my point about judging business opportunities strictly by the financial statements. Look, we all love getting a bargain. Maybe that explains why most investors are value investors. But getting a good deal when it comes to investments isn't based on the current value of the company, based on some financial statements. It's based on the potential future stock price. Notice I didn't say future value, but rather future stock price. Let me show you an example. So what you're looking at here is a graph of Apple, and you can see the years down at the bottom and the stock price here in blue. And you can see it was very low. It was 12.5 cents back here when they first went public. But you can also see that it rose quite a bit here. Now, would you buy this stock here? Now, knowing it's Apple, of course, you'd say, yes, of course I'd buy it. But I guarantee you'd look at this and go, well, it's gone from less than 25 cents up to 75 cents. So it's gone up by a factor of 3. Ooh, that's kind of high. I'm not comfortable buying it there. And by the way, it wasn't a value stock back then. So you wouldn't have bought it here. But let's see, maybe you would have bought it here. Let's try a different date. So, okay, you missed buying Apple back there at 75 cents, but now would you buy it at $4? I don't know. You look at that and boy, that's gone up a lot. Looks really expensive, doesn't it? Well, let's go forward a little bit more. Well, would you have bought it here? Now it's at a little over $8. In fact, I think it's probably at $10 or $12. This is a log graph, so it's a little hard to read. But yeah, would you have bought it here? I don't know. It's gone up a lot. I don't know if I'd buy it there. You get my point? In fact, let's take a look at where Warren Buffett finally bought it. Warren Buffett finally bought Apple in Q1 of 2016. Now you can see what he did. He waited for the stock to pull back. And in fact, by this time, Apple had enough earnings and the stock price had dropped enough that it met his criteria for being cheap. It was selling for less than its intrinsic value. So, Warren's done pretty good. Let's go forward to recent history. So if we look at here, Warren Buffett bought it somewhere in here, Q1 of 2016, and rode the stock up. So yeah, he did pretty well, but he missed out on all this growth. And I'll show you that in another table. So if we look at a couple of key events in Apple's history, we had the introduction of the iPod on October 23rd, 2001. At that point in time, Apple was selling for a split-adjusted share price of about 28 cents. I don't know what the price to value was at that point in time, but if we go a little bit further down the road, in June 29th, 2007, well before Warren Buffett bought Apple stock, they introduced the iPhone. And by then, the stock was selling for $3.71. Well, back then it was selling for roughly a price to value of almost 5 times, so clearly not cheap. But the growth from when they introduced the iPod to when they introduced the iPhone, the stock went up by 13.46 times. That's not percent, that's 13.46x. That's amazing. That's a lot of gain. Now, finally, Warren Buffett in 2016 decides to invest, but by then, the stock has gone up since the iPod was introduced 80 times. And since the iPhone was introduced, it's gone up almost 6 times. But he invests here in Q1 of 2016. And going up to April of this year, I developed these tables a couple of months ago as I was writing the script for this video. He had gained 7.6 times his initial investment. That's really good. That's almost 8 times his initial investment. But had he invested when the iPhone came out, he would have had almost 6 times 8 times his initial investment, or 48 times his initial investment. So did he do the right thing by waiting for Apple to have a price to value of less than 1? You be the judge. So again, getting a bargain at a stock's current price is based on the potential future stock price many years out. And that, my friends, is an unknown. But there's some guideposts and criteria any investor can use to evaluate a company's prospects. And what are they? Well, first of all, and the most important one to me, is that a company has to have a strong and well-developed vision and mission statement. I can't overstate how important this is. Without a well-developed and compelling vision and mission statement, the company, its board, its executive management, and all the employees don't have a clear reason for why they are at work and what they're supposed to do each day to move the ball forward. Kind of makes sense, doesn't it? Another criteria, and one that Warren Buffett likes, is strong barriers to entry, or as Warren likes to call them, moats. Another key attribute of a company is it has to have access to the best talent. You need good people to run a very successful company. And finally, the company ideally would have access to S-curve markets or disruption of large established markets. This is more important for high growth companies, but it's really nice if you want to see a lot of growth. Notice I didn't mention in any of these criteria for evaluating a company that the company is selling for less than you think it's currently worth. Let's look at the value trap investors, including the most famous one, Warren Buffett, fall into and how it hurts them. I discussed all of these elements that you should consider when evaluating a company, most of which, by the way, Warren Buffett uses in my video titled Tesla versus Apple, Who Wins? Link in the pinned comments below. So how does he miss great opportunities right before his very eyes? A purely value-based approach to investing will limit your returns and it won't protect you from loss. So why do most investors do it? Come on, how many of us knew about Amazon, Apple, Google, Netflix, and Tesla 10 or more years ago and didn't buy their stocks either because they were too expensive or they'd gone up too much already or whatever the excuse was? Let's take a look at how Warren's stock BRK-B performed and how it would have performed with small amounts of Apple, Amazon, and Tesla added to it. I've set this up so I can add different components into a portfolio. And right now, it's 100% BRK-B. So if we look over this 24-year period, BRK-B had a compound annual growth rate of 8.02, call it 8%, and a maximum loss of 53.86%. So decent return and a fair amount of loss. Now, what would have happened if instead of Warren buying Apple stock in Q1 of 2016, if he had bought Apple stock much earlier? Well, let's put just 10% of Apple stock into this portfolio. And what happens to the return? Oh, wow. So now just adding 10% of Apple into here, the return jumped from 8% to 19%. That's more than double his annual rate of return. And the maximum loss didn't change much. Got a little bit worse, but not bad. Now you could mitigate some of that through rebalancing. So we'll rebalance a little bit more. And now you see the return goes up even more to 22%. That's almost 3 times the return he got. And the maximum loss is better than the maximum loss he got. Not by much, but a little bit. Let's try the same thing with Amazon. So let's put Amazon in. Let's put this back. Let's let these run wild. Okay, so now I'm going to put 10% Amazon on. He admired Jeff Bezos and Amazon, but he just couldn't bring himself to buy the stock because it was too expensive. So let's just put 10% of Amazon in there. Well, his return went from 8% to 9.27%. So that's an improvement. Let's see if we rebalance a little bit, if it gets any better. Okay, so if we do a little bit of rebalancing, we don't just let both stocks run wild. Now his return is almost double what it was. And what if we add just 10% Tesla into the mix here? Now, before Tesla went public in 2010, I'm just assuming that he was in BRK-B, so it was 100% in BRK-B till Tesla came into being. So let's put 10% Tesla in here. Oh, wow. So his return went from 8% to over 18%. I think you get the idea here. Just by adding one of these growth stocks, and not a lot of it either, 10% into his portfolio, it doubled or almost tripled his potential returns. That's huge. There are several reasons value-based investing just doesn't work. Look, first of all, it assumes you can time the purchase of a stock or the market. Guess what? You can't. Second, it takes a short-term trader's view of a company's potential rather than an investor's long-term view. After all, aren't investors supposed to invest in the business and the people running it? Third, it ignores all the highest growth potential companies because they have no earnings. Part of the valuation of a company is its book or liquidation value, and let me tell you, that won't help you if you hold the common stock as we found out recently when First Republic Bank was seized and sold to JP Morgan. Just listen to what David Favor from CNBC had to say.
Final point for me, guys, on First Republic, but I think it's important to make. We haven't shown you the chart because there's nothing to show. It's a zero. Let's make that clear. First Republic stock is a zero. Its preferred is a zero. The debt, zero. Right. Sorry. We tried to tell everybody last week, Jim, maybe I should have made it clearer.
As you just heard David say, the common stockholders got zero, the preferred stockholders got zero, and the bond or debt holders also got zero. So book or liquidation value is meaningless and doesn't serve as a backstop. Finally, it tells me the person making that statement most likely hasn't done a thorough analysis of the company, the markets it serves, the competition, barriers to entry, potential innovation path forward, and the management team's strengths and weaknesses. Take a look at my video, Tesla versus Apple, Who Wins, for a more complete analysis of several companies using these criteria. Link in the pinned comments below. Ultimately, I think that buying companies at value prices is a backstop in case you either didn't do the analysis or you got the analysis wrong. Later, after the stock has performed extremely well, it also serves as a great excuse as to why someone didn't buy a great company when they had the chance at much lower prices. A long time ago, my mother gave me some great advice. She said, you can buy something cheap and end up paying twice, or you can buy something of high quality and only buy it once. I'll let you in on a secret. The highest returns will come from faster growing growth companies long before they mature into companies that would qualify as value companies. By the way, I'm not suggesting that you don't consider value companies in your portfolio allocation. They clearly have a place and a purpose, and I'll explain that in an upcoming video titled The Ideal Investment Portfolio. But until then, I'm Calvin Rose, and thank you for watching this discussion of value investing on Invest Smarter. That's all for now.